I think we've seen gold have these series of it rallies, it pauses, it stair steps its way up. These are called bull flags, which are very strong chart patterns. And the next move from here is actually pointing to, 50, 51, $5,200 per ounce for gold. So we can pull that down. I wish I'd get this blue box out of the way, but you can see we're going about, first level here is going to be the $4,700 for gold. And then I think we could go up here. And I do think, I'm always thinking the market is on the verge of a rollover and a big sell-off, but the things are aligning more and more now that I think at any point here, we could see a very explosive move, a very quick move, very similar to this one here, maybe even more powerful, that we could have that same move back up to this 51, 5200. And I think if that is the case, I think the stock market will be selling off. I think we'll be seeing money coming out of stocks, and then it's going to be looking for money, looking for a return. It's going to move into the precious metals space for one last big push. So I think there's a lot of upside in gold, silver, precious metals, and miners.
Growing volatility across global markets is shaping a landscape where capital rushes between risk assets and stores of value. Gold continues to build a robust upward structure, marked by steady rallies, controlled pauses, and the classic bull flag formations that often precede significant acceleration. As equity markets stretch into exhaustion and liquidity pressures rise, the probability of a sharp reallocation into the metals complex grows stronger. This shift is appearing precisely as precious metals carve out higher lows and prepare for the next extension. Chris Vermeulen, a technical strategist known for cycle-based market modeling, outlines how current chart structures point toward a potential surge into the $4,600 to $4,700 region, followed by a broader run toward the $5,100 to $5,200 zone. Capital rotation, weakening stock momentum, and the historical pattern where precious metals accelerate just as equities falter. A significant stock market sell-off could act as the trigger, unleashing a wave of liquidity into gold, silver, and miners for one final powerful leg higher before a more extended consolidation phase emerges. With currencies tightening, bonds attempting to bottom, and the dollar preparing for its own breakout, the window for strategic positioning narrows. Now, we present the clips from Chris Vermeulen's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
I like gold. It's got a series of bull flags kind of working its way up and to the right. It got a little frothy about a month and a half ago. Everybody was piling in who was open to the concept of moving into metals. And so it's had a pullback and a pause. Overall, this is a very strong chart pattern. I think we've seen gold have these series of it rallies, it pauses, it stair steps its way up. These are called bull flags, which are very strong chart patterns. And the next move from here is actually pointing to, 50, 51, $5,200 per ounce for gold. So we can pull that down. I wish I'd get this blue box out of the way, but you can see we're going about, first level here is going to be the $4,700 for gold. And then I think we could go up here. And I do think, I'm always thinking the market is on the verge of a rollover and a big sell-off, but the things are aligning more and more now that I think at any point here, we could see a very explosive move, a very quick move, very similar to this one here, maybe even more powerful, that we could have that same move back up to this 51, 5200. And I think if that is the case, I think the stock market will be selling off. I think we'll be seeing money coming out of stocks, and then it's going to be looking for money. It's looking for a return. It's going to move into the precious metals space for one last big push. So I think there's a lot of upside in gold, silver, precious metals, and miners once it finally hooks up and gets a bid. But I do think the stock market kind of is going to want to start to sell off first. I think we need to see money coming from somewhere to go into the metals space. And as we know, the stock market is way bigger than the gold market. So when the stock market does have a mass exodus and people are liquidating their stocks, there is going to be a ton of capital that's going to want to push and rush into the gold sector and drive it, I think, up very quickly. And this is what unfolded in 2027 as well. So if this repeats or rhymes again, it is going to mean that if stocks start to sell off, it means I think the top is in. And then if gold shoots up to this 52 level, I'd be prepared to exit the precious metal space, because I do think it will actually put in a significant high and then reverse and sell off with the markets temporarily for quite a while, for a few months or 6 or 12 months. If we do go into a recession and the stock market is selling and home prices are falling, all of that is generally going to start to happen around the same time. People get scared. People start to lose their jobs. They start to see all their value, all their wealth just vaporizing literally week after week. And any little downtick in gold or anything, it is just enough for them to be like, I need to get out. The thing is, when people get scared, the reality is most people don't know a lot about the financial markets. They don't understand how they move and why they move and how to track them and how to know when to own or when not to own something. So when everything they own is dropping in value very quickly, it's very easy to get overwhelmed, get scared, and be like, just sell everything. Just liquidate. I just want to move to cash. I'm tired of losing money. Everything I buy is going down. And they group all their assets into one thing and they just liquidate. And we see that. We see precious metals. We see things that actually are good investments just get pulled down with the liquidation. It's margin calls, it's fear selling. And so you're right, gold could hold up. There is a perfect storm brewing for gold to hold up or maybe even keep going higher as the stock market maybe goes into a huge reset and maybe the precious metal space never looks back. That's always a case, but I kind of always take the markets one leg at a time, one of these bull flag patterns at a time. I navigate it, I play it, and I don't look too far into the future because I know I'm not a buy and hold type of person. I want to play each leg, control and manage my risk and my positions, and just walk up with the markets or walk down with the markets, holding the right assets. So typically just when there's mass selling and global fear, everything kind of gets sold off. And this time could be different because we got central banks loading up with precious metals. We haven't seen this type of, I don't think, this buying before. So there could be a case that precious metals hold up or keep on going, and they actually just keep going higher as the stock market melts down. But I mean, we don't know, right? So you have to have a game plan. I have a game plan, and that's what I just follow the strategy and go from there. So gold has gone from, a little frothy to nobody wanted it, and it looks like it's put in a beautiful rounding formation. I would say it's putting in a base or it's bottomed. It looks like it wants to continue to go higher. I think there's potential for a very big move up in the dollar. If we do see some type of big financial problems, we tend to see the US dollar index rally. So that will put pressure on metals. And if this unfolds and this chart pattern is pointing to where it's going, I mean, it's showing a very big move in the dollar. I think the dollar could go a lot higher. This is only about to a 110. I think the dollar could go to about 116, potentially 121. And of course, if that's the case, it is going to put a lot of downward pressure on metals and commodities in general. So this is one of those other things that will definitely take a lot of the wind out of the sails for precious metals once the dollar starts to go higher. Now, I think the dollar could trade slightly higher and kind of grind sideways for a little while, for a few more bars here, a few more weeks, and gold ends up putting in a very big run, a big move to the upside. We can see them move together sometimes, and we've seen that a little bit more recently. So it's not out of the question, but eventually if things get ugly, we're going to see that, I think, the dollar shoot higher, and it'll just be going up so fast it's going to actually decrease the value of gold in the US dollar currency. For me, being in a cash position, I keep my money in US dollars because I believe we're going to see another big move up in the dollar, and the Canadian loonie, I think, is going to fall. So for me, moving just to cash, holding US dollars is a good play. You can play the dollar ETF, the dollar index ETF, UUP, and for people who are American who want to take advantage of the rising dollar itself. I think bonds, if we take a look at TLT, long-term bonds, they are trying to carve out a bottom. Let's just zoom out. It's a much bigger pattern. And I do think it's trying to carve out a bottom. And if the economy gets weak and oil breaks down, then we're going to see the inflation number really drop quickly because it's tied to oil. And so then there's room for rates to potentially keep getting cut. And if rates keep getting cut, then we're going to naturally see bonds want to move higher. And investors, we're seeing this more and more now. When there's a big down day in stocks, we tend to see TLT move higher. People are starting to go back to the norm of like stocks down, bonds up, and vice versa. So I think I think bonds have potential to hold some value and move higher. Those are kind of the two that I like. I think gold and precious metals, I think there's one leg higher. So I still think there's a nice trade there. But again, I think it's just a trade that's only going to last a couple of months. And you do have to like eventually exit to lock in those gains and purchase it. But Bonds and the dollar are the two that I kind of like at this point. I hold a lot of the dollar, so I do have the dollar play. I don't hold bonds like this. I'm not buying into bonds yet, but I think most of the downside is taken out of bonds already. Right now you got to protect your capital because there isn't good value. And then when everything's on a discount, I mean, it's you become the ultimate value investor. The problem is most people, when the big financial reset hits, they're all buy and hold investors. They don't
Yeah.
have a ton of cap. They're already holding all that stuff, but the difference is like exiting and then having all this cash to put in at the bottom to invest in stuff that's actually at a lower value. And so I do become a value investor. But right now it's like protect your capital, protect your money. The higher this market goes, the more leery I get, the bigger the correction I think is coming. So I do get more fearful. But again, if the trend turns up, we just have to hop back in and trade it. I mean, the trend is your friend, right? So I thought the market was going to top a long time ago, like a year and a half, 2 years ago, and it's still going up. So every time it turns a new trend higher, we jump back in and we have to ride it up no matter how much I like it or not.
Market behavior has shifted into a highly emotional phase, with price action driven more by reactions to data releases than by steady trend structure. Short-term charts show a clear bounce within a broader downtrend, and this pattern continues to produce sharp reversals as traders swing from FOMO-driven buying to panic selling in the same session. Momentum indicators are now rolling over, moving averages are sloping downward, and critical support levels are being tested as volatility expands across major indices. This emotional rotation extends into speculative assets as well, where wide swings, failed breakouts, and instability signal the increased risk of deeper declines. Temporary bounces may occur at familiar support zones, but the larger trend remains fragile. With sentiment deteriorating and volatility rising, the environment favors caution, capital protection, and disciplined trend tracking rather than aggressive positioning. Let's get back to the interview.
From a technical standpoint, the trend of the S&P 500 and the Nasdaq are down. They're in a short-term downtrend right now. And so all we're having at this point is a bounce within a downtrend. Now, what's interesting is we've been sloshing back and forth with this emotional roller coaster. So on the 30-minute chart on the left here, you and I have covered this several times. So this red indicator is known as our FOMO indicator. That tells us when people just pile into the stock market, they feel like they're being left behind. They have to buy now because the bottom is in. And so that's what we saw on the S&P 500 and the Nasdaq last week. Everybody piled in at the open, and then suddenly this was on the back of Nvidia news, and then later in that day we had unemployment news. Which took it the other way. So everybody wanted in the stock market a couple of days ago. Later that session, we had three waves of panic selling that created these three big pushes to the downside. And so these indicators that I have drawn here, when they cross above these blue lines, they are usually extreme pivot highs and lows. And so we can identify the market. So it's going from everybody wanting in to later in the day, nobody wants in anymore. They're bailing out. And on Friday, we ended up closing with the FOMO indicator above this blue line. And when we close above the blue line on a Friday, all the emotional traders who didn't get in, feel like they, over the whole weekend, they're like, I need to get in. I need to get in. They just kind of ruminate on like, I got to get into this stock market. And so that's why we've got this gap up and we're seeing this follow through buying today. It's like this kind of feeding frenzy. And it was interesting because it was just large caps moving the markets early this morning, as you and I were recording this on the 24th. And now it's kind of turned into a kind of a bit more of a broad market rally. We're seeing the micro caps and the small caps participate. And typically when everybody gets into the more speculative plays, that's actually a little bit of a contrarian sign. Now everybody's starting to get excited about the stock market again, and we're in a downtrend. And usually we're going to probably see some more selling. So I don't remember what your original question was, but this market right now is very emotional. And we're coming down. We're testing this very critical support level on the chart right now. We had it fall back a couple months ago. It's bounced back up. It's now come back down to this significant level. And now the big question is, how is it going to trade sideways on this chart? I've kind of really messed up that chart. But in the big picture here, we could be putting in a shoulder, a head, and another shoulder. And a head and shoulders pattern is a very powerful topping pattern. And when you break the line that connects the two shoulders, that's when you get a very big precipitous fall. Usually the height of from the top of the head to the neckline gives us the downside target of where it could go. So we could see the S&P 500 potentially, if we break down over the next month or so, down to like $614 per share, which is about a 7-8% correction from where we are. So we really just need to sit back. We moved to cash a couple of weeks ago. We moved to the sidelines because the market was saying it didn't know what it's doing. And now we're seeing it with our tools, our indicators, that the emotions are all over the place. Nobody knows where it's going. And that's why we step aside. We don't need to get involved in this scenario. But if you notice the moving averages, David, the 50 days starting to slope down. The 20 days clearly sloping down. The 5-day moving average is now below the 50-day. So the momentum that has always kind of been up and to the right, it looks like it's actually coming to an end for a significant correction. And so we could be very close to something bigger than just buy this little dip and you're good. A week or two from now, I think it could be you buy this dip and you might be underwater for a long time. There's a lot of panic selling going on. It's definitely pulling back into a pretty critical support zone. And when you look at this price action, I think you and I had talked about this a while ago. I wasn't a fan of Bitcoin because it has this broadening formation of series of higher highs, lower lows. It's meaning there's more volatility. It's increasing in risk and volatility on every wave. Every time it makes a new high, it gets rejected. It becomes a fake out. And then it makes a lower low. And then it finds a bottom and rallies. And so it's a terrible pattern. Very difficult to trade. It's not worth trading. And they usually resolve to the downside. Eventually, it's just showing instability. It's in between buyers and sellers. And we ended up finding it breaking to the downside, and it's picked up speed. You can see the volume. There's a ton of selling going on, a lot of fear in the space. And it has dropped right down into that kind of around the $80,000 per Bitcoin mark, which is kind of in this blue box. This is where a significant breakout took place back in 2024. It's a major bottom that we found earlier this year. And so it's just dipped down into that level where there will be a bunch of people saying, hey, if it drops into this range, I'm going to buy some more. People who bought it back in March and April. And there'll also just be other traders who look at it and say, well, if it falls here, this is a previous support level, I'm going to buy it. So right now we're just having a technical bounce. It's in a downtrend. There's a lot of selling, and it's just a bunch of buyers who are trying to pick a bottom here, and they're buying it at a support level. So it's getting a little bit of a bounce. The big question with Bitcoin is what is going to happen next? And that's where we need to figure out, is it just going to trade sideways and really flounder and then eventually kind of break down and go for another swan dive? Or is it going to have a fairly decent bounce? And is it going to play out for a couple months? I think it's going to follow the stock market. I think if the stock market struggles here and rolls over, Bitcoin is going to break down and we'll probably be headed down to the $60 or $50,000 mark very quickly. But if the stock market does bounce, I do think we could see Bitcoin bounce. I wouldn't trade it for the bounce. So right now the trend is down. You don't want to try and pick a bottom. So I wouldn't trade the bounce. I'd be more inclined to potentially look to buy an inverse or play the downside. If it does bounce up and starts to roll over, I would look for some type of pullback and kind of go from there, or wait for it to start to break down through this level again and then potentially jump on board, because this is an emotional asset, very emotional asset. And once it starts to break a very critical level, everyone starts to bail out on the trade very quickly. And it'll sell off. It'll be like a landslide, just like this last one. It'll be a string of red bars with huge volume. And there's enough momentum and enough people that panic in Bitcoin at the same time that it'll create a big move. There's the same waves in Bitcoin to the upside and the downside. When it breaks out and starts to run, they all jump on and they drive the price up. When it breaks down, they all panic and they bail out. And so there's very good opportunity in Bitcoin because of that. And we've traded it a few times recently because of these strong moves. And there might be a really nice breakdown here in the next month or so. Well, generally, the kind of analysis is a trend is more likely to continue than it is to end, because it's the thought process of a group of people. They're all thinking and feeling the same things. They're putting their money in that direction. Price action is really telling us what people are thinking and feeling, and obviously what they're doing with their money. And so that's the main driver of stock pricing. It's not fundamental data. It's not the government. It's none of that stuff. You can have the strongest companies in the world and still see a stock price get cut in half or fall 70%, all because there's a lot of fear in the overall market and selling. So the charts tell us what people think and truly feel about a particular stock at any given time. And you're better just follow price than anything else.
With volatility intensifying across equities and digital assets, the market tone continues to shift toward defensive positioning. Short-term rallies are emerging inside a broader downward structure, where declining momentum, weakening moving averages, and rapid intraday reversals highlight the strain beneath the surface. FOMO-driven surges giving way to sudden liquidation pressure, creating an environment where support levels are repeatedly tested and trend signals rotate quickly. Speculative assets are showing the sharpest reactions, with expanding ranges and increasing instability, reinforcing the need for caution. As capital moves in and out of risk assets more quickly, the focus shifts to strategies that preserve value while waiting for more explicit confirmation of the next significant move. Monitoring trend shifts, sentiment swings, and broader liquidity behavior becomes essential in navigating this phase. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.